Welcome here with all our listeners, all fans of Blackfort, all specialists interested in investments. Today we have a CIO call, which we make accessible for all our partners, clients, and our subscribers. We would like to share our views, the views of Andreas Bickel, our CIO, who was the former head portfolio management at such companies as Goldman Sachs in Switzerland, Deutsche Asset Manager Group in Switzerland, and Rothschild Bank in Switzerland. He will share his views not only with our team, as we do it usually, but with all our audience. And we will have a little discussion round in the end. With these words, I would like to hand over to Andreas and his presentation.
Thank you, Gleb, and welcome from my side. Let me share my screen with you. Okay. So today's presentation is around a similar topic like last time. Last time we had sell in May and go away. The answer was no, which turned out to be not the worst advice I have given. This time we are beginning of August and July, and that's normally a difficult time period for markets in general, and in particular for stock markets. So shall you sell after the strong rally the market, or do we see a time correction? Given that I wrote time correction, there is implicitly already given a partially of the answer. So as usual, we start with some macro updates. I will concentrate on indicators and not on facts we already know, because facts they are already priced in. One of the questions I was asked several times, do we have a taper tantrum or do we have a taper starting maybe in January next year without a sell-off in equities, so without a tantrum? We had so far across the globe hammer results, really hammer results, but a lukewarm reaction in the US and in Europe, and in China and in the rest of Asia we had turbulences, and the markets basically ignored the good results. After that, I think key question will and is, are we in a bubble? And I will show you my thoughts, and I will use the framework of Ray Dalio, which has put together the last 4 bubbles, including the actual one and what his assessment and what my take is. For actual reason, obviously, we have to cover China, and will it spill over to the rest of the world? And we will stop with commodities, gold, and some currency outlook. So if we start with the flash PMI data, which came out this week, and the next week we will see the final figures, we can say 2 things. In the US, the service sector is slowing down. So the figures go down below 60. But for those of you who have never heard about it, everything above 50 means there is growth. Everything about 55, there is acceleration. Above 60 is very unusual, around 60 as well, and we came down from almost 64, so from a very strong overreacting, maybe overheating, to a still very strong growth in the service sector. And underneath you see that the PMI, so the industrial area, is still above or at around 50, and the manufacturing is even on the series high. So in the US, there was never a higher reading of this market data. This market data is collected since roughly 2005, and therefore the history is not so long, but the good thing is you have twice a month an update. So the narrative in the US is solid, strong growth above potential, but slowing down. Completely different the picture in Europe. In the Eurozone, we see that the composite PMI, so putting together the service sector and the industrial sector, is on a 252-month high. That is almost the highest reading we have ever seen on record. Also here, the service area is slightly lower than the manufacturing area, but given that we had until recently lockdowns in France, partially in Spain, partially in Italy, I think it's still amazing that we are so high. Also, given that the latest turbulences on the weather front in Germany have not really affected the outlook for the service and industrial area. So therefore, the narrative for the first time since 2009 is that Europe is for a short period of time outpacing global and especially US economy in terms of expected growth rates, which has impacts on the stock market. However, year to date, Europe is up roughly 15%, while America is up more, slightly more, 16 to 17%. But based on forward-looking data, we can definitely say the picture is unchanged, even slightly brighter in the Eurozone. If we try to see what market tell us about the future, you probably have seen that the treasury yield has dropped to around 1.25, 1.3%. That is a sharp drop. There are arguments around that this price is manipulated, / there was a forced selling from hedge funds because they were positioning and betting on higher yields. And after the Fed meeting 4 weeks ago, not the one yesterday, 4 weeks ago, we saw a strong sell-off in gold, and we saw, funny enough, a strong dollar, and we saw with it lower yields, so a rally in treasuries. Basically, this picture tells us a similar story. We can expect good growth, but slowing growth. The data is slightly distorted to market actions and to Fed bond buying, but also from that angle, there is no recession, and also the recession part was updated. You can see that there was roughly 2 months with a recession in the US. That's the red shaded area. And all the bad forecasts, all the bleak outlook, like 35% negative growth in Q2 last year, in the end, it turned out that there was state-induced short break recession of 2 months. And since then, we are growing and we are stimulating and we expect more growth. What is amazing are the option-adjusted spread for corporate bonds across the globe. If you just look at this picture, basically, they are unchanged since the 4th of March. 4th of March is in the left hand, just as a picture to show you the levels. And if you compare them to the actual levels, they are roughly at the same level, in some cases slightly higher. However, the yield you get at the moment is higher. Markets have corrected over the last 2 weeks. So emerging market bonds, on average, deliver you now a higher return or a higher yield. Having said that, the flip side obviously is that the bonds have, due to turbulences in the Chinese area, starting from the real estate, and the latest was the education sector, the yields have risen sharply and bonds fallen. But the valuation or the spread option adjusted is stable roughly, which is amazing. There is, when you are at these levels and at these levels for a while, there must be a warning. All markets are expensive, but in particular, the junk bond market or the high yield market is at levels last seen in 2007. And you know what happened after that. It is very difficult to foresee when we will see a widening of the spreads. However, I would not expect that this can continue forever. For the next 12 to 24 months, we will have more stimulus. It probably will keep these spreads at narrow levels. It might be that they get tighter. It might be that equity markets will support that by rising. However, down the road, in the future, this spread will widen and it will hurt. However, on the other hand, if you want to invest in bonds and you want, as a start, a positive yield, you are forced to go at least to the triple B area, in most cases even the double B area. But in the US, as an example, the yield on quality double B bonds is roughly 3%, and 3% for something which is double B is definitely overpriced. But there are no alternative. This year, or at least over the last 2-3 weeks, you would have made a lot of money with government bonds. The reason you can see here, this is the total amount of negative yielding bonds globally. We were in December at 18 trillion. In May, we were at the low level and thought from now on we will see yields further rising, and this amount of negative nominal yielding bonds decreasing, only to learn over the last 4 weeks mainly that the opposite has happened. So a rally in government's flight to quality, and the yield has more dropped. The question obviously is, what will the central banks do? We got another hint this week at the press conference of Mr. Powell from the Fed. He confirmed that they will start talking about tapering, and the estimate in the market you see here, roughly at the end of this year, maybe beginning of next year, there will be a cut in the purchasing program from 120 billion to maybe 80, maybe 100. And this will mostly be done in the mortgage-backed securities and not in the treasuries. Therefore, we will see a continuation of accommodative policy. So the money printing is ongoing. And as the market is really prepared for it, my take is that there will be a taper without the tantrum. So it will not spill over to equity market. It will run and last for a while until maybe this bubble will burst, but that's still open given the strong earnings. We can argue if markets are overpriced, and if so, by how much. But to that we turn later. The other reason why I'm at the moment not so worried about defaults and rising yields and slowing growth is this. The US, excluding the infrastructure stimulus, which was in one parliament agreed already this week, they will stimulate 25% of GDP. And if you see all the other countries, I mean, even China, who is controlling the credit growth, is even pushing around 5% into the market. And China just really recently announced that they lowered the reserve rate. So you have now as a bank to keep less reserves and you can lend more money. So across the board, you see stimulus. And this stimulus from the fiscal side is the important point, because most private individuals and corporates do have on their balance sheet more debt due to Corona and still working down from the financial crisis. Therefore, if you want to get out of this, the only way is fiscal stimulus. And for roughly 1 year, 1.5 years, we are there. And with that, you see two things. One is that the growth is accelerating and it's expected across the globe to be above potential growth of the countries. And on the other hand, you see asset prices, in particular equities, rising. Turning to the broader picture, so putting it together, bonds, debt, and valuation and markets, I all keep saying that we have a similar situation like after World War II. This chart is from Bridgewater, so from Ray Dalio. He keeps saying we are at an area end of the 60s, beginning of the 70s. When I compare the money supply, the money surge, that's the red line underneath, you see that in both time periods, so from 2010 to now, and from 1930s and the Depression and then the World War, and in particular after the World War, the building up, you saw a surge in money supply. In both cases, the blue line, you see the rates. So the rates in the 30s, 50s were close to zero. We are at the moment close to zero. There was inflation in both cases. And in the 50s and also in the 30s, there was for the first time on record a deliberate stimulus of the economy by taxes, like this time, so the fiscal stimulus. And the reason in the 30s was to repair the balance sheet, and after World War II, the same, to repair the balance sheet of the states. Today, it's the states and the corporates and the private individuals. That means basically that the stimulus will transfer wealth from people who are not invested in real assets to the state, because the real debt to GDP ratio will decrease. And you see that above, there are these red circles, which Dahlia and Bridgewater calls cycle changes, turning points, and that the debt in total amount percentage of GDP is rolling down. That's the only way out, in my humble assessment, out of this huge debt problem we have at the moment. And if that holds true, the forward-looking future is that this low yield environment is even after the announcement and changement of policy of the Fed going to stay. Most developed countries cannot afford to have rates of 4% on their government bonds, because basically they cannot finance or refinance the state budget. The tax income would be too low. And therefore, it is probably fair to assume that over the foreseeable futures, bonds will be a very tricky investment, and equity will stay overvalued for a while. However, there is also good news, that is the growth of earnings. But in the meantime, let's first concentrate on the outlook of inflation. Basically, the Fed keeps telling us this is all transitory, so only for a short while. The biggest part comes out of a base effect. Basically, last year you had negative effect on oil prices, energy, and you had the lockdown in Q2, and all this feeds in, and because we have now a growth rate. But markets tend to price that in. So you see here inflation expectation on the break even for 5-year forward. They are rolling over, but they are still at 260, which is significantly above 2%. That's a goal. I think for the first time one can argue that this view is not completely wrong, because it basically means we will have inflation which is above the previous targets, and it will stay sticky. This is still open here. Today, the Fed is always telling us we look at the PCE deflator. It will be published today at 2 o'clock, 2:30 Swiss time. The expectation are that we see a surge to free spot 7% from free spot 4. Both the figure 1 month ago and the expected today are higher than what the Fed and the consensus has expected. That basically means that the nominal, the real GDP we have seen yesterday of 6.5 was disappointing, and the nominal figure, which is obviously much higher, is partially inflated away. Therefore, we have seen yesterday a disappointment on that front. On the other hand, it is a moderate growth, and people on the equity side, the reaction was, well, that basically means that the Fed will not have to raise rates soon because growth is slowing down. However, the flip side is the inflation. It can get out of control. We see higher commodity prices, which are definitely putting PPI up, and PPI will producer prices will then feed in consumer prices. So the inflation theme is really to be watched, and the way to protect yourself is to have real assets, only the cash you need for the plannable and foreseeable future, and the rest to be invested. And unfortunately, to live with volatility. We have seen over the last 2 weeks too many pullbacks in global equities, a sharp pullback in China, which we will cover in a minute. And we have seen in emerging market bonds a sell-off, but it is hard to find other areas to invest. You can invest in gold. We will also come to that. There are other assets, but normally the accessibility is only for ultra high net worth individuals. Otherwise, you buy REITs. REITs have the problem that they fluctuate with equities, but long term they deliver you the real underlying return of the real estate. Having said that, it is a kind of obvious, but if you see the curve, it's a bit shocking. So if I take the 10-year treasury yield and I subtract the core CPI, so even excluding the volatile energy and food part, you get to a negative real yield of -3%. The last time we have seen that was in the 70s during the 2 oil price shocks. And you probably know that at that time inflation was skyrocketing and we had recessions. So it is really worrisome on one hand, but on the other hand, I'm not so sure if the Fed doesn't have a hidden agenda, i.e. the financial repression theme, in order to mid-term, and I repeat mid to long-term, solve the debt to GDP problem. This chart shows the same thing with TCE deflator. You see, even if I use, let's say, a less volatile measurement for inflation, you are down at more than 1% negative real yields in the US. And for the rest of the world, just as a reminder, the nominal negative yielding bond is at almost 17 billion globally. So bonds is really, really a tricky asset class. And in some cases, outside of the dollar, you start already below zero. And if you take the dollar after adjusting for inflation, you end as well below zero in real terms. On one hand, we do see that inflation is heating up, because here you see Dr. Copper. The copper price had over the last 3-4 trading days a huge price spike from 9,000 to almost 9,830, which is a strong move. It underpins that the expected growth rate is still here after consolidation. We see now in industrial metals, and copper is one of the key ingredients for the green revolution, for the production of electrical vehicle. We do see a surge, similar picture in iron ore and other industrial metals. So the message from that is twofold. On one hand, we see growth, but on the other hand, the impact on PPI, so producer prices, and down the road inflation is unfortunately rising. You can play that theme, be it with a ETC on copper, so you can really play the copper, or you buy copper mining shares. Copper itself has risen, the mining shares are lagging. The mining shares are partially in emerging markets, and they were more trading with emerging market equities, which were sideways and slightly down than with the underlying metals. Are we in a bubble? The short answer is, if you look at the total market, it is elevated, but some areas like prices are discounting unsustainable conditions, growth, forward looking for the total market. Ray Dalio thinks there is no bubble. And people are having excessive buying, forward looking, and loans also there. He thinks for the whole market, no. in the emerging tech, so the new tech companies, the Einhorns, as they are sometimes called, there the situation looks different. Almost all of his indicators are either in a bubble area or frothy. On the other hand, for the total market, he concludes on his framework that we are in areas where we should watch out, especially, for instance, new buyers. Yesterday, as an example, Robinhood went public, and the stock was down 8%, and also the initial price was set lower. This was actually expected, but the key message for us answering this question is they have now 21 million new users, so 21 new buyers of equities. That's a huge amount. They have moved markets and squeezed out hedge funds in the example of GameStop, or in AMC, the cinema chain. They have pushed up the price dramatically, and also got some hedge fund on the wrong foot. The sentiment of these people is extremely bullish. You see similar things in Germany, which is an area where investors or equity culture is not existing, but also there you see on some of these neo brokers a bubble area and a lot of sentiment, and even some buy on margin. But overall, this chart was done 4 weeks ago. Overall, given the recent strong earnings, the valuation of the market, of the US market, came down from 28 times PE, which is extremely high, to an actual one for this year of roughly 22. It's still high, but 22 is roughly where we have been over the last 2-3 years, with obviously a fluctuation. If you take a Schiller PE, which is 10 years adjusted real earnings, and compare it to the market valuation, we are at 37. That is in an overvalued area. However, the last time, or the dot-com bubble burst only after we have reached 45 and higher. So you can conclude it's expensive. In some measures, in the Schiller PE, we are in a bubble, but that doesn't mean that it will burst over the coming weeks. Most likely it will go on. One key element is still missing. I do not see among most people, new investors, but especially shoe shining boys in the 29s or taxi drivers today's, nobody is giving you advice or asks you, shall I sell something, maybe with the exception of cryptocurrencies. So therefore, it is frothy. It probably will last. You can also do that in a more systematic way. Bridgewaters, they have a measurement tool where they take the S&P 500 or 1,000 smaller caps in the US and evaluate company by company how many of them are in a bubble area, so massively overvalued. Based on their framework, you can see that the S&P, we are at roughly 3%, and I would argue with the recent earnings, we're probably down below 2%, and it's slightly higher for the smaller caps, but compared to the last bubble, there is still room. The good news at the moment is earnings season. Here shown by the US, because the graphics and the data material available on Bloomberg, free available, is unfortunately scarceful in Europe and the rest of the world. But in the US, we have every day an update. And yesterday, we can see that 90% of all reported companies have beaten substantially, not just a bit, substantially the already elevated earnings. Apple, as an example, one day before they announced earnings, analysts have pushed them up. Similar thing to Alphabet or Google. and both, really both, have outblown all the estimates. However, the market had a lukewarm reaction, but you can also see it in a positive way. There was not sell effect. The exceptions to the rule is Amazon. The figures were good. Expectations were pulled up over the last 10 trading days. The result was a drop of 8% because they didn't really beat the elevated estimates, and they made a cautious outlook. But bottom line, we can say, and I said it before, PEs are roughly at 22, and that I look as expensive, but still not worrisome. One key question is peak earnings, peak growth. If you look at this is from FactSet. It shows you the quarterly expected and realized earnings. So in Q1 this year, where more than 20% of all where the growth was by more than 20% beaten compared to estimates, we had an aggregated S&P 500 earnings of $49. If you multiply that by 4, you get to total aggregated earning of roughly 195. At the beginning of the earnings season, the expectation was at 180, 185. And with that, obviously, you had an evaluation far above 25, near 30. For the actual earnings season, FactSet shows that the analysts expect a lower figure also for Q2 and Q3, and only before the year end or Christmas shopping, etc., we would overpass 50. I do think, and based on the actual earnings season, the Q2 earnings will be higher than Q1. And I am really seeing no reason why Q3 should be lower than Q2. And I do believe that Q4 and Q1 next year, and also probably Q2, are too low. And if you come from the strategic side, the estimates are for 202 earnings, and if you divide 202 by 4, you get more than $50 for each quarter. So therefore, from the earnings side, the market is well supported, but the reaction is lukewarm. Are we surprised? The answer should be no. This year is an amazing year. This chart I have been using several times, and there was sell in May, go away, or the second part of June is a negative year, a negative part of the year. Actually, the chart so far only errored or misguided you on the downside, because every time it should have been down, it was rather up. We are now entering August. You see that the Nasdaq is expected to be flat, slightly down, similar to the S&P. There will be some volatility, and then September, October, we see a stronger move up. However, so far, if you look at the S&P and the Nasdaq, this correction pullback has not happened. If you look at this chart, you see the yellow marked 2 weeks period, and you see they are more on the right-hand side, so on the weaker area. Therefore, it is now a difficult time of the year. I said it before. Here you see the aggregated medium returns since 1950. The funny point is that the second half of June would, in theory, be the worst 2 weeks period of this time year. It was actually a very good period. But what it basically tells you is there is volatility ahead, and given the strong earnings, probably this year we will be better than the medium return. Having said that, the next huge story is starting from Asian tech, continuing with Chinese real estate, continuing with the latest, the educational stocks in China. Will this spill over? Makes this sense? In our bi-weekly, we have a special section dedicated to that. I was attending 2 seminars this week, and I learned a lot about the way the Chinese government probably looks at it. As you probably know, they have decided some time ago switching from 1-child to 2-child policy and now to 3-child policy. In reality, the birth rate was continuing to shrink, and there were several reasons. And the several reasons were prices of living, costs to raise a kid, and in particular tutorials for preparing your child to enter in one of the top universities in China. From the angle of the government, all this regulation have 2 drivers. One is to give the Chinese consumer bottom line more cash in their hands by reducing the cost for living. So real estate, which was already regulated, got a bit more regulated, but important is to know the government is not forbidding that you do profits in the real estate sector. So there are no NGOs, etc., but they keep a kind of maximum margin, a kind of maximum profit which is accepted from the government, and that the impact of the society is limited. So the prices or the surge of prices is limited, but it's still a capitalistic system. Tech, yesterday there was an announcement after the crackdown, and you know what happened with Didi. You probably saw Alibaba, Tencent, and. The key message is twofold. A, we want these companies to continue to be profitable. However, they have to comply to our rules. So if you are like Didi collecting data of the behavior of the Chinese citizenship, you have to keep them safe in their own country. But once you comply to all these rules, you can still go to the US and you can still raise external capital. You don't have to go just to Hong Kong or to mainland China. That was a promising statement. Second, Tencent Music is a good example. Tencent, a huge conglomerate, extremely profitable, is quoted in the stock exchange in America and also in China. They are forced that, for instance, their music business, they give away the rights, the exclusive rights of music bands and music in general. The Chinese government wants other competitors. And here is the red line, if you will. They want that we see more competition and lower prices for streaming. Similar thing for the Ant Group, which was forbidden to do their IPO. They want that it's separated to a certain degree from Alibaba. It was also against the main shareholder, Mr. Ma. But once this company is set up the way the Chinese government wants it, it is not ruled out that they will go public, and they can do that if they want in China. But they want that certain duopolies, monopolies are split up. And we have also to see that over the last 5-10 years, there were no regulation steps. So they basically are behind the curve. They have to adapt to the new digital world, to the new reality, and that's what they are doing. Therefore, this is not something new, but at least all the Western people who write about it and who are invested there and who are experts. And I mean, yesterday I met virtually somebody who lives in Asia for more than 25 years. He said, this happened in the past, it will happen in the future, but don't underestimate the flexibility of the entrepreneurs in China, and do not think that the Chinese government wants to go away from a capitalistic, profitable system. So this is a temporary effect. Midterm, you might have opportunities. with obviously the exception of the education system, because the education system, they are now NGOs, so non-profit organization, and therefore you cannot invest in such things. You see it here, the orange line, that's the largest education company. There were others, I just took one. Until March, it was on a surge, it was all-time high, and since then it lost 90%. And I think it's amazing that you see the market somehow anticipated something. Similar things with Didi. Nobody knew exactly, but somehow there were rumors, and some insiders, they knew that. The dark green line is the Hang Seng Tech Index. It basically puts together Asian tech. Most of them are obviously China, but there was other shares in it. It had a huge correction. Also in March, all-time high, has had outperformed the Nasdaq 100. That's the violet line. In the meantime, we have a huge gap. We expect that midterm these stocks will recover. Turning now to commodities, I updated today this chart. 2 days ago, the spike you see at the end was not there. So the OPEC has made an agreement to increase production. That you see in the price drop. It coincided with the Fed meeting 4 weeks ago. And since then, we had a little consolidation and are now back on track. So over the coming months and weeks, probably slightly higher oil price is in the card, which also has an impact on expected inflation. Gold, I also updated this chart today. Different to 2-3 days ago, we are now trying for the second time in roughly 8 weeks to overcome the resistance level at the 50-day average. The 50-day average is now at 1,822 and a bit. And as we speak, or at least when I started this presentation this morning, updated it, we were $1 higher. The jury is still out, but there are supporting factors for gold. One is obviously the negative real yield across the globe, the continuation of stimulus, the expected sticky inflation, and the headwind was the strong dollar. But the dollar has, since roughly 2 weeks, turned weaker. The reason is funny. You see here in the middle, in yellow circles, the positioning of the industry, mainly hedge fund guys. They have turned for the first time since a very long time bullish on gold. Last time I gave this speech, I said that Goldman Sachs was the last bank who turned bullish on dollar because the dollar index rose a lot and they were really suffering and getting some cynical comments. And at that time, I said it's a question of time until it turns, but it's a bit too early. This chart is from Monday. And if I see what happened from Monday till now, you see that the dollar is starting to rolling over. I expect money flow to continue in that way, but I would not bet on an extreme weak dollar. So it is slightly weaker. Interesting enough is that the euro is strengthening to a part. You can explain that with the growth differential, but not to the full extent. So it's more flow driven. Bitcoin is the tricky bit. We are at the upper end of the trading range. Yesterday I got from a short-term trading oriented research house, there is a pullback. Well, yes, it has happened, but look, today, this is from this morning, back we are, almost at 40,000. Amazing here is the reason why it went up. There were 2 faults. One, the rumor that Amazon will accept until the year end Bitcoin as a mean of payment, which was 3-4 hours later denied, but Bitcoin was already up. And before that, the first move of this leg up was that Mr. Musk said we consider Bitcoin to be less dirty than before, and the impact on the Tesla earning was extremely minor. It was less than 30 million, so really peanuts. And last but not least, Ray Dalio, Bridgewater, said he's selling gold and buys Bitcoin. All this news, this Twitter news, moved the market. From a technical point and from what I hear from the news flow, it can well be that we will retest the 60,000, and it might happen then what was announced at that period, that we got double then. But this is really news flow driven. It is hard to have valuation. With that, let me summarize. Macro view is strong in some areas like the US, rolling over, but from overheating to a Goldilocks, good growth is actually good for equities. Inflation is here to stay. It's not just the base effect. By the contrary, we will build up a new base effect if the metals continue to rise. Negative real yields, be it on bonds, be it on equity earnings, on dividends, you get negative real yields if you take inflation into consideration. Excuse me. I still keep my theme financial repression, which I've elaborated, and I do see hope because the balance sheet recessions, or the huge amount of debt by the state and especially by private individuals and corporate is tackled with fiscal stimulus. So if you want to invest, high yield in the US is still, compared to the alternative offering you something like 3 to 4% yield, is extremely low. But compared to all the other alternatives and fluctuation, the US high yield space is probably in relative term the safest play. If you want more yield, so more means 4.5 to 6, after the recent painful correction, China, Mexico, and Brazilian corporates do look extremely attractive to us. In Asia and China in particular, you have to be very careful. One real estate developer was more or less defaulting due to the intervention and new regulation of the Chinese government. We have considered that bond and would never have thought that it would default, but we thought the valuation is too high, and we were fortunate enough to invest in others which are more profitable and less high valuated. But having said that, the flip side of the whole thing is when one went down 25%, which we were able to avoid, but the other one went down 5 to 10%, which we were unfortunately invested. But if you are investing in that area, it is extremely difficult to hide. Areas to avoid, I mean, treasury yield at 1.25, maybe 1.3, really tricky. It can well be that due to money flow and external shocks that we go to 1%, but midterm, I would rather bet to see 1.80 plus minus a range. Cash, given the inflation outlook, is kind of obvious. You need cash to pay your bills, so cash management is key. But once you have that organized and in sufficient cash, the rest you have to put to work. The question is obviously where. There are no cheap asset classes. It is only a relative play, and it has also to be said that we are extremely high valuated. We are, as Mr. Dalio put it, frothy, bubbly-ish, like a word creation which doesn't exist. Not yet in a bubble. Therefore, at the moment, I keep with a lot of headache Europe as an attractive area, because they were since 2009 cheap, but for once they also show growth. Asia, an emerging market, is cheap. However, there is turbulences, but there are good opportunities, for instance, in Brazil. if you believe that oil goes higher, and if you see what the Russian market did, it might be worthwhile to think about it, at least if you are investing as an international investor. Tech, as long as Mr. Biden and China doesn't produce more crackdowns, tech are growing, produce tremendous return. And some even say if you split up Facebook or Amazon, so cloud and retail, or Instagram and Facebook, the individual parts might be more worth than the conglomerate. We see across the globe small caps and cyclicals performing pretty well. We do not see values performing well. The value guys have updated their forecast. The forward-looking return over the next 7 years from GMO is that, with the exception of value in emerging market equities in all asset classes, you are going to lose money. They have said that since probably 10 years, and now it got even more pronounced as the valuation got more expensive. I wouldn't see it so bleak. I still believe we are rather in the roaring 20s, disruptive technologies, stimulus. But having said that, we also know how the 20s ended. So watch out if we are getting more overvalued, more babblish. It will be a tricky thing. Therefore, we would recommend to go in areas where there are shortages, like, for instance, microchip producers, or you go in commodities, in metals, in precious metals, in real estate. All these things will be volatile, so watch out. But if the bubble bursts, there you have, in all cases, real assets behind. They will have a certain value. With that, I would say rather mid-term positive view and cautious long-term view. I would hand it over for questions. One last thing, if you want to have more, so daily updates on market, feel free to join us on our Telegram channel. Some of the noise you will get there as well, but I try to keep the broader lines as well, so from time to time to have an assessment of how we see the world from a helicopter view and a midterm outlook. With that, I would like to hand it over for questions, and thanks a lot for listening.
Thanks a lot, Andreas. It was a great presentation as always. And thank you also for mentioning the new Telegram channel, which is available to all interested. We had this channel previously closed for only the team, which is handling the assets in Blackfort Capital. But now we actually open it to all interested as professionals who are seeking advice and investment ideas and comments on the markets and so on. So I want also to line out that we do have, for subscriber who are interested, regular updates on the bond markets. We have a bi-weekly, we have a Blackfort Insight, which is analyzing current situations of the market. We also have some trade ideas. So in order to subscribe to these information flows, you would need to go to our website and basically subscribe there. It's a very easy process. Wherever you're watching this video on YouTube or LinkedIn, you will have the links below. So thanks again, Andreas. And then I would like to start with the first question, rather one coming from the retail market. We know a couple of months ago there was a big story around GameStop. Retail seemed to take over the markets. Everybody was talking about that. We had some factors which did lead to this situation. We know that the number of retail investors, for example, in the States grew from 10% to 20%. If you talk about the big markets, still having big companies, banks, financial institutions controlling, let's say, the trade, but it's an upcoming thing. And I think the access to the trade floors and to the via different apps and via different programs for the retail investor is growing. How do you see the changes in the, let's say, in the charts, the changes in on the capital markets because of the growing influence of the retail sector? And do you see this in general? Thank you.
That's a great question, and the short answer, do I see it? Yes, of course. It's a big theme because these new guys, so 21 million just in Robinhood, this new, let's call them investor, they call this, or they play it like a game. Gamification is one of the words you might have heard before. And the thing here is, like in manifestation, they organize themselves in boards. They communicate the target, and GameStop was a good example. They knew that some hedge funds are short, and they knew that GameStop is in a transfer process. And then basically they played the game. Can we beat the slughead slash the hedge funds? And yes, they could. And one hedge fund had to be saved by another hedge fund. They repeated the same story with AMC. I mean, AMC is an okay-ish cinema. What I hear, they had problems to position themselves. They were closed. Maybe they were not at the edge to go bankrupt, but definitely they were short sellers for reasons which are understandable. And again, through Reddit boards and other channels, they organized themselves and they pushed the price to the moon. The effect was twofold. Some hedge funds made huge losses. That was actually the purpose of the game. But on the other hand, if you see it from the angle of the company, in both cases, so GameStop and AMC, they were able to raise capital. They were able to increase their equity shares at prices which were ridiculous. But put it the other way around. The company is now safer than ever, has more cash, and if they are not completely stupid, then can position themselves in segments where there is growth down the road. Further questions?
I would have one more question from my side. We see a growing demand from our investors and from our clients, but also can see that at other financial companies which we work with together as our partners, the growing demand for the option to participate in pre-IPO story. So basically be able to invest in companies which are not yet at the market. We know that there are some reasons why it became easier and maybe less difficult than 10 years ago because of growing transparency, because of growing information flow and accessibility, the possible to access this information. What do you expect in this context? Again, the first question, am I right? Do you see this as well, the growing interest, and do we expect based on that a growing numbers of IPOs coming up, or what is your standpoint on this behavior we see now in the markets? Thank you.
Woof. Well, it goes hand in hand with what you have asked before, because with this gamification, there is also a democratization in equity markets in general. What I do mean is that retail investors and maybe affluent clients have access to things which were in the past only for ultra high net worth and for institutional clients. Concrete example, Facebook. Coincidence, I was working for an institution which was pre-IPO with Facebook. We placed the assets with ultra high net worth individuals pre-IPOs. It was really, really hard. Then there was an IPO which was not really successful short term. In the meantime, Facebook, as we all know, is one of the big players. But all these pre-IPO investors made a lot of money because they were invested pre-IPO. The IPO was compared to their purchasing price at a much higher level. And now we see similar things, but the accessibility to affluent and ultra high net worth and also to smaller clients is here. So that is definitely true. Yesterday, the example was Robinhood. I mean, although the first price or the closing price was 8% below the initial price at the IPO, everybody who was pre-IPO invested made a huge profit. And the jury is still out if Robinhood down the road will continue to grow as they expect. Therefore, if you have access to pre-IPOs, the probability that you do money is significantly risen, and I do see the trend. The IPOs obviously do depend on market conditions, and if you see the tech market at all-time high, it is a kind of obvious that it gets attraction, be it in the biotech, be it in the tech, in all these new disruptive technologies, all this venture capital, they would like to get a step further. And then after the pre-IPO, obviously to go IPO and public. I do see that as long as markets go up, that will continue. But you also see it in traditional markets. I mean, humble Switzerland, we have very few IPOs, but the pipeline is now huge. But look where the market is, it's at all-time high. So it's a phenomenon of the time. Together with the gamification and democratization, this process is probably going to last. Any other questions?
Yes, so this is Pavel. Apologies for the picture. So yeah, my question really is, Andreas, and thank you very much for such a thorough review. My question is, given that we have so many of the flags signaling an overheated market and valuations that are really through the roof, in pre-IPO world, and also equities, and all the liquidity that is continuing to be printed in the United States, and the infrastructure spend also in the US, that's, I think, going to have a positive impact, a multiplier effect on other industries, which I am not sure everybody is accounting for at the moment, that multiplier effect of the infrastructure spend. But, given all of this together, what can really be the catalyst for a major turn in, this 12-year bullish market that everybody seems to be forgetting, that we're over 13 years now in one of the, longest bull markets in history of humankind, actually. So, you start to wonder what can be the catalyst to the end of this crazy exuberance, and how bad can the correction be? I mean, can it be worse than 2008? Can it be worse than the 30s in the United States in the Great Depression? Can it be the end of the dollar as a global currency? Because obviously, by all means, the United States are bankrupt. Just nobody's talking about this for some reason. If you look at all the reasonable ratios, first of all, there's a lot of unaccounted debt that people are not talking about. I mean, everybody lost measure of the real debt of the United States. So to summarize the question, what can be the catalyst and how bad can it be? Thank you.
Oof, you touched so many points. So what can be the catalyst? Obviously, it can be anything, but given the latest speech of Mr. Powell 2 days ago, my take was we will deliberately let run the economy hot. We want to see the unemployed people, so not the ratio, but really the people who are not working, or you can turn it around, the creation of jobs to surge significantly. For that, we will allow inflation to overshoot for a longer period of time, and then we will sharply interact. And this sharply interact can only mean to raise substantially and quickly policy rates. And if that happens, all the valuation models crack down, because basically you change a key variable. That could be the trigger. Obviously, it can be that there is a recession, etc., etc. But normally, when you stimulate so much, this is at the moment not in the cards. Trying to elaborate a bit more, can it be worse than the 30s and 2009? It is also extremely hard to say that, but I would say no. And the reason for that is simple. 2009 was less severe than the 30s due to the fact that Mr. Bernanke, together with the input of the inventor of the balance sheet recession, did the right thing. A, they did monetary stimulus, which didn't create inflation, and B, in the language of the Americans, they ensured that the economy doesn't fall off the cliff, i.e., they did a huge fiscal stimulus. And as you know, the US came very fast out of the crisis. Their banks are the strongest in the world. They recapitalized almost the whole economy industry. A stupid example, for instance, GM. I mean, GM was bankrupt so many times, but in reality, it's now one of the leader in the EV space. Debt to GDP, the chart, no, not debt to GDP, the total debt measured, which Bridgewater shows in comparison to GDP, is more than 300%, and some is not, as you just mentioned, not calculated. So they are basically bankrupt. Fully agree with that statement. Therefore, you have only two ways to solve that. You either do a currency reform and cut some zeros, like the Germans did twice over the last 120 years, or you do what is my theme. You basically spread it over 10, 20 years by letting inflation be 2% higher than the state-controlled yield, and you inflate it away and you stimulate it and repair balance sheet with fiscal stimulus. If that will work is open, because the figures are, compared to the past, really huge. But if I were to live after World War II, I mean, debt to GDP in the US, they were also bankrupt. And due to the stimulus measurements they did, the situation for me is similar to that. That's why I keep preaching financial repression and balance sheet recession, a thing I learned over the last 10 years. Balance sheet recession I knew before, but financial repression I knew before, but the balance sheet part is an explanation why after 2009 the Americans came out so strong. Europe came out so strong after World War II, but as we all know, there's the growth in Europe and the stock market and it is a catastrophe, or at least was until this year. And even this year, although we see strong figures, we are still seeing Europe underperforming America, although it's much cheaper. I still think it's to a certain degree a value trap, but at the moment I do see growth. I don't think that the rescue plan of the ECB will put money in the right project, but still I cannot deny that there is a lot of money printing, and this money is put to work, which puts obviously the problem into the future. And also, if America is bankrupt, I mean, look at Italy, look at France, look at Spain, not to mention Greece, but Greece is small. They are all bankrupt. And there is the same thing. I mean, you can only do a currency reform, which the German will do everything to hinder that, because they had seen that twice. The euro should break up, and there should be a North Europe and a South Europe. I don't think that's going to happen because of political reasons. Therefore, there will be more money printing, and they do also financial repression, and they even do now debts, although it's forbidden from the constitution, but debts on the Eurozone level. They have found a trick, but nevertheless, economically speaking, basically they behave like a state, although they are not, and they're issuing debt. And the only way to solve that is with inflation, financial repression. And The only really positive is the digitalization, the disruptive, the new technology. There are areas we cannot even imagine what they will come and have the growth. But on the other hand, obviously, if you're in a traditional, for instance, bank, I think it was Bill Gates said once, bank is a piece of software. At that time, people were probably laughing. Well, look at Robinhood, look at Neo, look at all the things which are around. They are a piece of software, but you can bank on it. You have it on your mobile. And this is real thing. We can talk of gamification, we can talk of democratization, but this thing is ongoing, and human brain is not able to foresee or to deal with growth. I read a stupid example. What is 5, 5, 5, 5, 5? The answer 35, because 7 times 5, completely wrong. 5, if you take 1 spot 0.5 and to the power of 5, so you do the compounding effect, you get at 70,000 something. And this is not something our brain can handle, but this is what I'm hoping and counting for, that we see this kind of compounding effect in growth. And with that, if I'm right, I can be completely wrong, because we are in an experiment in the history we have never seen before with all this printing. That is the only way out, unless we do painful cuts, which means currency reforms, capital restriction, etc., etc.
Andreas, I'm flattered by such a thorough response, which is in itself, a discussion on an extremely important topic of, change of cycle or prolongation of cycle. I mean, who knows? I mean, maybe we're in a 30-year cycle, as you say, productivity gains, new technologies, inventions, ESG. Yeah, I'm also, want to be optimistic. I'm very happy that Blackfort has an investment product that captures these new companies, the high-tech companies, which unfortunately, have crazy valuations, often 100 times revenues. And, this is beyond belief. But but hidden there is the new future of humankind, because if you took a look at the Tulip Amsterdam exchange, I don't know, 200 or how many years ago, and and where equity value is today compared to that exchange, you would say that this is a dream around us and all the value that the humankind has provided. Maybe we're just in the beginning of another leap, and it happens quickly. The internal combustion engine transformed humankind. Internet is transforming humankind. So you want to be optimistic and really hope that the human ingenuity has no limits in managing the overheated, by traditional measures, economy today. We're all holding dollars. Russia, I think currency reserves are in gold and dollars. China, dollars. I mean, obviously the Swiss franc will be very, I think, stable. That will position us well. Will probably be very bad for the Swiss economy, for tourism. But I agree with all the kind of the positive comments that you made, and I think I fully agree with the fact that there's not going to be anything very rough and disruptive, but it will probably be an evolutionary approach towards managing and containing the exuberance that we're seeing around us. Sorry for taking the the floor.
No worries. Let me add one thing, and also of the bull market. The one thing is, 1 year ago, or maybe 1 year ago and 2 months, everybody was thinking it's the end of the world. But people underestimate the adaptation of mankind. I mean, nobody likes home office, but actually, if you get yourself really organized, you can be as productive as in the office. There are a lot of disadvantages, like the human interaction is not there, but still, we didn't fall off a cliff. We managed as a society globally that this somehow continued, and we are getting out of it. It might take some while. And the last bit on the stock exchange, which obviously is completely out, but my theory, and I can only know in 5-10 years if I'm right or wrong, but my theory is that this bull market has, like the one from 1982 to 2002 parts. And the two parts means we had a tremendous bull until the forced crash last year, the 2-week crash, the shortest on record. And since then we have again the second bull market. If that's right or not, I don't know. We will see. What I can add is, since that we have, besides monetary stimulus, the new element of fiscal stimulus. Okay, with that, if there are no more questions, I think
Thank you.
You're welcome. In the light of the time, I would like to thank you all for your participation and also for listening, and hope to see you another time.
Thank you, Andreas. Thank you, all the participants. Have a great day, and looking forward to receive more interesting insights from you, Andreas. Thank you again.